Hello from snowy Denver, Colorado. I'm Justin Susi, and today I'm joined by Lou Harris, and we're going to discuss our 2022 market forecast. Before we get into that, a little disclosure from the attorney and compliance folks, just a reminder that past performance may not be indicative of future results. And before we jump into that, Lou's going to give us a little bit of updates on the office, what's going on with the team, and then we'll get started with our agenda.
Yeah, we welcome two new kiddos to the G&S family. You can see right in the middle there, that's Tara with her son Wyatt, who was born back in December. On the lower left side, that's Jasmine and her son Cannon, which they welcomed back in July. So a couple good family photos up here. Up on the right, that's Jasmine's crew. And in the lower right, we've got Tara's older daughter, Scarlett. So G&S family just continues to grow.
Lots of babies.
Yeah, lots of babies, exactly.
Yeah, so on to our agenda, we're going to cover kind of our typical topics: domestic equity, international markets, fixed income, and then look at sort of 2022 hot topics. So starting with domestic equity, we're going to cover the Fed cycle, earnings growth, and market leadership. When we get into the Fed cycle, really what we're talking about is the Federal Reserve starting to raise interest rates, which is expected this year. There's an old market adage that says, don't fight the tape or the Fed. So again, the tape is whether the market's moving up or down, don't fight that general direction. And then the Fed, if they're easing monetary policy, you don't want to fight that versus if they're making monetary policy a little bit more restrictive. So we'll get into that a little bit. And just a reminder, if January hasn't started that reminder, stocks are typically weaker the first year of a Fed tightening cycle. A little bit more into the weeds on that. If we look at various years from 1969 to 2018, these are years where the Fed has been aggressive in raising interest rates, so maybe 2, 3, 4 rate hikes in a given year. And what we can see from this is that typically leads to some market volatility. You can see whether it's stocks or bonds or various different sectors, it just is uncertain. And some trends you might notice here is that usually pharma or drug companies, healthcare kind of does a little bit better in these cycles. Same with technology. That's not necessarily the case this time around so far. It's just a little bit of a mixed bag as we approach the first Fed rate hike cycle since 2018.
Yeah, so just talking about earnings growth, it's been a little bit all over the place for the past 2 years. Analysts weren't sure what companies were going to announce as far as earnings, so they sort of took it easy on them the past 2 years. And we're seeing the earnings and anticipation and the earnings announcements become a little bit more in line. And so it's important for companies to have continued earnings growth that should be reflected in the price of their stock and then should be reflected in growth in our portfolios. So on the next slide here, we'll see this chart, which is pretty interesting in the upper right corner of the top chart. We saw back in 2020, the dotted line being the forward earnings estimates and the dark line being the actual company earnings announcements. Those two should start to align more with each other. As you can see back in the like 2010 to 2019 range, those two lines should be more in line. And essentially talking about how analysts are predicting a little bit lower estimates, you can see in the bottom right of the chart, the consensus for Q3 of 2021 was 25% below actual earnings announcements. So we should see this correct back, hopefully towards zero, again, aligning the analyst expectations with what companies are actually announcing. So we'll be watching that pretty closely this year.
The other thing that's interesting is the market leadership. What we mean by that is which companies are really driving the overall gains throughout the market. Right now, that's pretty narrow, and we also have some volatility. And what we mean by some narrow leadership is that when you look at the companies above the line here, Apple, Microsoft, Google, NVIDIA, and Tesla, these 5 companies generated above 30% of the return of the S&P 500 last year. So again, that's kind of a way to look at it as the big big companies, the generals we might call them, have been driving the return, while the other 493 companies in the green circle down here have not been adding a whole lot to the overall growth of the market. So again, we'd like to see that broaden out. That's a little bit narrow. Another way to look at that is that looking at the NASDAQ, or whether it's the S&P 500 or even small companies, we can see that the average stock within these benchmarks is down quite a bit more, and this was through December 20th, than the actual benchmark themselves. So this is a really important point because we've seen pretty major corrections happening underneath the surface. So for NASDAQ, for instance, the average stock is now probably approaching being down in the neighborhood of 40 to 50% as of today, but the benchmark itself is now down about 14. So it's starting to catch up with the overall market and with some of those generals, and we'll see if that turns into a little bit more volatility. And then speaking of volatility, the last chart here really just shows the VIX, which is a measurement of volatility. You can see here that when you have spikes in the VIX, usually that corresponds with, again, market uncertainty, downward movement in stocks for a period of time. Last major jumps in volatility here were obviously kind of the COVID timeframe, March of 2020. We've had some decent spikes around 30 and 40 as well as we've recovered from the pandemic. And then lately here, we came back down and now we've spiked up to about 29 today. So, hopefully that starts to ease. When that starts to ease, you kind of see the market maybe move a little higher after that point in time. So increased volatility for the time being.
So moving on to international markets, for the past 10 years or so, the U.S. market has been in a bull market and the clear global leader. And about this time every year, we review and look at all different parts of the market to see where is there opportunity internationally. We do think that there are some opportunities right now, and I'll kind of go into that through the next couple charts. But just talking a little bit about global GDP, is it slowing down or speeding up? Chinese and emerging market struggles, also just some general global headwinds and tailwinds from what's going on here in the US and how that impacts global companies. So when we look at the growth projections on the next chart, this is the World Economic Outlook from the International Monetary Fund. 2020 was negative across the board for everybody, global, advanced, and emerging markets. Last year was pretty close. What the difference is, looking at 2022, on the right side, looking at emerging markets and developed economies, the growth outlook is 5.1, and versus the global being at 4.9, and then advanced economies being at 4.5. We do see some opportunity for growth there, and a lot of that comes to some supply chain issues that have been affecting not only us in the U.S., but global manufacturers as well, and also just the rise of the consumer outside of the U.S. Mentioned this last year that a lot of countries that are considered emerging markets are just getting their first iPhone or their first iPad and are kind of plugging into the world of e-commerce. And being in the world of the consumer being king, that could definitely bode well for a lot of tech companies that are really in growth mode that could spread their wings internationally. So on the next slide, what we're going to be looking at here is, this is a pretty important slide. We really like this just to show how long it's been since we've seen market leadership outside the US. And so what you're looking at here is the blue being the international leadership in the world, the green being US leadership. So the green last 14.1 years has been led by the US markets. And what you can see going way back even to the 70s is that it's usually on a pretty even keel when market leadership switches regimes. And so what would cause the next shift is for international markets to be ahead of US markets for the cumulative 12 months. So if the international markets are doing better than US markets for the first 6 months of the year, but not the full year, we wouldn't see that shift. And so as you can see, we're kind of long overdue for this regime shift, and it may happen pretty quickly, kind of that built up pressure and sort of this coiled spring of the supply chain going on to where other parts of the world can have a year like the U.S. did back in last year in the second half of 2020. So be interesting to see. We've got a lot of opportunities that we're looking at. Some of our models, we're definitely taking a few shots at different areas of international markets at kind of underweight holdings right now, but we anticipate some of those should be increasing this year, in case you see those come across your individual.
Yeah, Lou makes a good point there. For those of you that remember 2000 to 2010, that was a period of time where you had a lot of outperformance in the markets from international versus the U.S. So very good point there. Lou also is a little bit colorblind. So for those of you that, the green and the blue, those might not have made sense, but the purple is international outperformance. The gray is international behind. So yeah, who knows,
Thanks
Lou?
for
There
that,
might
Justin.
be
Yeah, my wife, she reminds me that I'm color deficient all the time. So
there
thanks
might
for
be
the
other
help
people
there.
on the call that are. Yeah.
Well, this is an interesting chart. Once we talk about PE ratios, we're getting into the weeds a little bit, but we look at price to earnings discounts as buying opportunities or how expensive a stock is. So what we're trying to illustrate on this chart is that the PE ratio for the rest of the world outside of the US is around 14.3 times earnings. The S&P average right now is about 21.2. So what that's telling us is that international investments are kind of on sale right now, and so or not quite as expensive as US. And so yet another reason to take shots where we feel it's appropriate in some of our models, whether it's looking at value parts of the market or other more higher quality investments in international. That we feel like there's definitely opportunity there, and we should probably see these two PE ratio components converge towards each other this year as the S&P comes down and international should pick up a little bit. Next chart, we just thought this was interesting. A lot of people are constantly talking about this, the container ships stuck off the coast in LA. Just looking back to about a year ago, the cost to ship something from Shanghai to LA was about $1,500, and right now it's about $12,000. So a lot of that coming into play with the rising cost of goods and finding employees to move the ships, to move the containers, to put the containers on trucks. All that goes into the rise of in cost of everything that we're paying for and trying to order and things that are on back order. So just kind of crazy how it's over, $1,500 to $12,000 in the matter of a year.
Yeah, almost 10 times the cost in some areas.
So we haven't been hearing a lot about China over the past year. And what's interesting is that they are essentially a year behind the US on their monetary policy. So right now, China is actually easing their monetary policy, and they're lowering interest rates. They're providing stimulus to their country and their people to drive consumption and investment outside of China. So the last three bars on this chart are pretty telling. First quarter 2021, it's off the charts on investment, consumption, and net exports. And those have quickly come down over Q2 and Q3 because they are essentially in a position where the US was this time a year ago, which could be good for China. A lot of Chinese investments that we follow have had a really, really bad year last year. And so we think there could be opportunity there as they've essentially bottomed out. They've got easy monetary policy, and it could be, with the rise of the consumer, could be a good investment because they have been a little bit too quiet here over the past year. So we'll be watching that pretty closely.
And as we move on to fixed income, so bonds, fixed income, inflation, again, these are probably some topics you're hearing the most of in the media and different news outlets and are affecting the markets quite a bit. So let's first take a look at interest rates. This was at the end of the year, the expected curve that the Fed was on to increase rates. I think the longer that the time goes here into January, market participants start to think that the Fed might act more aggressively throughout the year. So, we obviously also think there's going to be interest rate increases throughout this year. that's designed to try to help with inflation and different things like that within the economy. Certainly an outlier would be if they only raise rates maybe 2 times this year or 3 times this year versus maybe four, then you could see the market cheer that and see some better returns as well. When you look at the fixed income markets as well, this has last year up here, just returns, where do you go? Because again, when interest rates go up, it's a difficult environment for fixed income. So looking at this chart and the number of different fixed income type investments on here, we have spent most of our time, most of the portfolios are in floating rate, ABS and MBS securities, municipal bonds. Again, these were some pretty good areas to hang out in last year, and we think those will be good areas to hang out in again going forward. Trying to stay away from treasury bonds, things that are really long in maturities. Convertibles and high yield, these can be sometimes almost as aggressive as equities. So we typically don't consider these as the safest part of your portfolio. We try to keep that in these types of bonds and then take our risk with the actual stocks in the models. Similar look here. This is the yield curve. So down here in the bottom left, we have short duration maturities. So 3 months, 1 year, 2 year, 3 year. We come all the way out to the right. These are 30-year bonds. So when you look back at 2013, you used to get about 4% on a 30-year bond. So that would mean the government pays you 4% per year, and then 30 years later, they give you all of your money back. That got to as low as about 1.19% back in 2020. Right now, these have come up since the end of the year. Right now, on a 10-year bond, instead of 1.52, you're at about 1.8. So as this curve increases and flattens out a little bit, the Fed's just going to have to be careful that they don't invert the curve, which means that these shorter term rates get much higher than the longer term rates. Because again, for banks and the financial systems, they want to basically, borrow money at these short-term rates and then lend it out to other folks at these longer-term rates and make money on that spread. Lastly, maybe before Lou jumps into hot topics here, or actually go ahead, Lou, you do hot topics, and at the end, I'll kind of wrap things up.
All right, sounds good. Yeah, so we always like to cover things that are in the news, things that people are discussing and calling in about, and we see some opportunities with thematic investing, and so we'll go through that first and just touch on the Great Resignation. So what we're looking at here is 4 different areas of thematic investing that comparing kind of the traditional versus the old versus the new. The new being what worked really well in 2020, the year that loved growth companies and clean energy and tech. Also with 2021, which is more in love with the older traditional valued companies. Now we think 2022 is going to be kind of a blend of both. So, as long as there's constraints in energy, we do think there will be more oil getting, sucked out of the earth and being used to make all the things that we need it for. But we also think there's going to be advancements in clean energy, especially with the government and private mandates. So we're watching both sides of the ball there with energy. Automotives, we know that there are not a lot of cars for sale right now. We can't get the chips, can't get a lot of the parts and pieces needed to manufacture these cars. So once the supply chain issues get resolved, hopefully this year we should see more vehicles come on to sales floor. And on the newer side, looking at electric cars, we feel like there could be a win for lithium and any battery company really, because all these car companies are at a race to continue to develop electric cars. And so as there's a scarcity of supplies, we think that's an area too that could be strong this year. Financials, we of course hear a lot about cryptocurrency, which has been extremely speculative, especially as of recently. It's under a lot of regulation and speculation right now, so we consider it still really early in the technology adaptation phase. Capital markets we expect to do pretty well this year with in a world of rising rates that typically bodes well for financials. So we'll be tracking that closely as well. And finally, labor. You know, playing both sides, we've got the Great Resignation on the traditional old side. On the new side, we've got robotics and AI. And so when you have countries that have a lot of people that are quitting their jobs, we need to replace that work with robotics. So there are a couple funds out there that we're tracking in both AI and robotics that are interesting. Still pretty early, still a little speculative, but we are monitoring that pretty closely. And last but not least, the Great Resignation. As of November last year, 4.5 million Americans had quit their jobs, mainly going to be in the accommodation, food services, and retail trades. But on the flip side, hiring has been unprecedented as well and has been exceptionally high. So we feel like there's just a big shift going on, continuing to monitor where these folks are going, where they're headed, because I know I've had a lot of conversations with clients about what are all these people doing that are quitting their jobs. And so as long as the economy is doing well and there's a shift going on, we should see that reflected in the jobs numbers on both sides. So I think no one's really quitting their service job to go into mining and logging, but I think there is a flow out of some of the retail space into more manufacturing, education, and health services.
Yeah, and kind of interesting too, Lou, where the biggest age group missing from really the employment market is the 20 to 29-year-olds. So if anybody has a child or grandchild or niece or nephew that's living in someone's basement, doesn't have a job, you know, kick them out, get them into the workforce. But yeah, really, really big segment that's missing from the workforce. So they can't all still be in college. There's got to be some of them out.
It's always grad school.
That's right. And just sort of wrapping it up here too, I mean, just some big picture things you've probably seen in the markets here the last few weeks. Again, more volatility. The market is, depending on what you're looking at, has pulled back maybe anywhere from 8-9% to almost 20%, a little over 20% for some small and mid-sized companies. So there is a correction happening within the markets. There is nervousness around the Fed and raising rates and what earnings might look like the next couple of weeks. Looks like the market might be getting a little overdone to the downside. So again, we're kind of expecting that things will settle down a little bit, and don't think that just because the Fed's raising rates or just because we have inflation doesn't necessarily mean that the bull market is over. We don't have enough information to say that at this stage, but we're focusing on good quality companies, quality earnings, stocks that pay dividends. What we've really tried to stay away from and what's really getting hurt in the market is kind of your high-flying companies with no earnings and lots of debt. So those are companies that are just sort of getting crushed within the market. So again, we're focusing on quality, good companies. We've got a little bit of cash in the models that are more wealth preservation focused. So anywhere from kind of 10 to 20% in the active equities, equity incomes, the TTs and TTLVs. So again, kind of weathering this storm, and we'll see where we go from here. But we're almost to our 10% correction spot. Maybe that'll bring some buyers back into the market. Maybe too, again, obviously call Lou or I. Tara's still on maternity leave, so we won't bother her yet. But if you have any questions, give us a buzz, shoot us an email. We're always happy to talk you through it. We've had a lot of people introduced to us in the last few weeks by clients, a lot of referrals. People just kind of want some additional help on how to position in this next stage of the market. And I think we're well positioned to help them through that. So friends, family, coworkers, if there's somebody that needs help, feel free to have them reach out to us, and we'll take good care of them. So again, thank you very much. Appreciate you taking the time. And Lou and I will say goodbye and sign off.
All right. Thanks for listening, everybody.